Hey, good afternoon. Coming to you again from the headquarters of Teeple Snyder Newsom. I'm here with my good friend and partner, Matt Snyder. How are you doing, Matt?
Good. We're doing well. Kicking off the new year always starts with a New Year's resolution.
Yeah.
Our family, actually, one of the goals that we've deeply desired, we moved to a new house a couple years ago, and I feel like we've settled in a little bit, and our goal is to be able to open it up more frequently and be hospitable. So we're actually launching a new community group with our church, and being able to meet weekly with some fellow believers and encourage one another. So what about yourself?
Yeah, so I've always tried to do New Year's resolutions pretty holistically. For years I've had a goal worksheet that I fill out once a week, but I've been slipping. And comprehensively, I mean spiritual goals, relational goals, both with friends, with family, scripture reading, community groups, things like that. But it was physical exercise that has really slipped for me. And for most people who know me, they know I love to be outdoors, hiking, really testing my body, climbing mountains and whatnot, and I just have not been able to do nearly as much of that in the last year. So most people have failed on their resolutions by this point already. I'm hitting my stride, so hopefully that keeps up. But you know the saying, if you don't have a plan, you're planning to fail. I think that is the case with New Year's resolutions and personal goals, health goals, financial goals. In fact, the scripture speaks to that. I've got Proverbs 21:5 pulled up, and it says, the plans of the diligent lead to abundance, as surely as haste leads to poverty. And that's, again, the Bible speaks a lot about money and the tie we have to our heart, and it's not a sin to accumulate wealth as part of a plan. The sin is where your heart treasures money more than it does God. So having a plan is wise. Scripture speaks to that, and we like to help our clients with that.
Well, when you're a financial planner, you tend to prioritize planning. But I totally agree with you. If you don't have a plan, you do plan to fail, and Scripture backs that up. And we're really encouraged to see the efforts and the diligence put in by each and every one of our clients as well as they seek to plan, and it's a joy for us to be able to partner with them in that.
Absolutely. Well, we're here to talk to you about the economy and the stock market. It's been an interesting last year with government shutdowns and tariffs and things that we either have never had before or they breached longest shutdowns ever, things like that. So there was just a lot of uncertainty, and what we're seeing now is more certainty. And a lot of just normalization. There have been things that have come back from out of whack circumstances into things that are more normal, more sustainable.
Yeah, certainty is always, can be fleeting or disguised, but to your point, normalization. I mean, we are seeing some healthy trends. Not everything may be rosy, but when you look at things like the labor market, when you look at inflation, compared to where expectations were, like a year ago, compared to where they are now and what the overall trend has become, especially leading into 2026 now, I mean, we're seeing a fairly stable and healthy economy.
Yeah. Well, unemployment has creeped up, but it's in the mid-4s. Inflation has been a little bit sticky, but it's in the upper 2s compared to the Fed's goal of 5% unemployment as full employment and 2% inflation as steady prices. We're not too far off. Other things that we're starting to see normalize is the pace and trajectory of the Fed rate cuts are starting to slow and kind of level off. I think a lot of expectations are they'll get down to 3% on the Fed funds rate and level off. Those days of 2.5% mortgages are done and should be done. That is not a normal thing. That's too stimulative. When you get down to 0% interest rates, which is what the Fed had it at for many years, over 2 different cycles, they just got no arrows left in their quiver to combat a weak economy because they can't go to negative interest rates.
And the Fed kind of is sitting in the sweet spot right now. They're basically saying, we don't need to lower rates because the labor market isn't showing signs of major stress, might not be ideal.
Right.
But they're also looking at inflation and saying, we do want to see that come down still a little bit more, but it's also not a raging battle like it was before. So they're able to take a calm, level-headed approach. And if there's anything that investors like, if there's anything that the stock market likes. It's that a Fed that is stable and not making rash decisions.
Right, 100% agree. Yeah, a couple other things that are normalizing the money supply, which the bigger the economy, the more cash and liquidity you should have. So we need to see, if the economy is going to grow, we need to see a steadily increasing money supply. What was so out of whack was during COVID, we had two different presidents that between Trump and Biden injected $5 trillion of cash into the economy, creating liquidity that created inflation, probably also kept us out of a Great Depression, but also we're facing the long-term ramifications. That said, the Fed reined it in, and now we're back to increasing the money supply. I can't understate how important that is to the long-term economy.
Yeah, I mean, and really that dip that we saw in the money supply is pretty significant. It was the first dip after the major boom that we saw year-over-year decline in the money supply, which many economists were very gloom and doom when they saw that dip happen. But on the heels of a major surge in the money supply, it definitely leveled things off, and seeing that slow upward trajectory again that we've normally seen for the decades before COVID is a good sign. It says that our economy is back on a track.
Yeah, for sure. Well, I think the market has kind of internalized this data, and recession risks objectively are going down. One of the slides that we're covering with our clients this quarter is a chart by Ed Yardeni, who is a notable economist and has charts on everything. But he's got a model, probably uses similar inputs to the Conference Board's leading economic indicator, but a recession probability model that shows percent likelihood that in the next 12 months we go into a recession. Well, that spiked a few years ago in 23 when everybody was talking about recession, and we didn't have one. Probably only because of nobody knew how to quantify what the effects of $5 trillion of stimulus were going to be. So all these other indicators were suggesting recession, and yet we never hit it. And this model went up to 65% recession risks. Well, at the beginning of last year, again, with this unknown data, tariffs, potential inflation spikes, things like that, we went up to almost a 50-50 probability of recession per this model, and at this point we're down to low 20s.
Yeah, it's come down pretty remarkably.
A lot has changed. Now, valuation, is it still a concern?
It depends. Still, once again, I mean, we've been tooting this horn for a while now. It's that valuation is a major concern. You look at the valuation of large companies, especially the aggregate S&P 500, for example, way outside of its normal range.
Right.
But you look at the rest of the economy, you look at small, mid-cap stocks, international stocks, look at those valuations, and they're running, if not in their historical average, maybe even just a hair below. Now that has changed just a little bit because just over the first few weeks of 2026, 3-4 weeks into this year, I mean, we have seen massive outperformance in small and mid-cap stocks. Maybe short-lived, but we have been suggesting that from a valuation standpoint, that's where there's a lot of opportunity. And so reasonably right now, that stance hasn't changed. Now, is valuation a concern broadly? Well, kind of hard to say, but definitely in large caps, not as much in small and mid.
Well, large caps have had an incredible run, and like all good things must come to an end at some point. So maybe that's starting to wind down. Now, one of the key differences I've heard is people have compared the dot-com bubble of the late 90s to what might be an AI bubble, is that there is still profits happening. Nobody can question NVIDIA has had incredible profits. As we have been shoring up AI infrastructure, it's been the infrastructure providers that have benefited. Not as much the AI consumers. We haven't seen huge productivity lifts enough to justify all the expenses yet, but the hope and theory is that that will come, and we'll be on a different playing field than we ever have been before. Remains to be seen if that will be the case, but AI infrastructure spending, even just among the Mag 7, into NVIDIA, and then NVIDIA has partnerships with all kinds of companies that they're investing in other players who are providing revenue back to NVIDIA. There's just this almost interconnected web. And AI infrastructure spending has gone up 400% since the beginning of COVID. 2020, it was about $100 billion of infrastructure spending. Last year it was estimated about $400 billion. In the next 2 years, that's expected to rise to $600 billion. Well, there's only so much money that you can have before that runs dry. Companies are taking their operating cash flow, spending investments into AI infrastructure. And if you look at that, we see a operating cash flow going up, but the discretionary cash flow left over after you've made these expenses is going
Come down quite a bit.
So at some point, we're not going to be able to see infrastructure spending continue to lift the whole, be the tide that lifts all the boats.
Yeah. The big question is the infrastructure spending going to have to continually be perpetuated for many, many years on an ongoing basis, or is this a front-loaded expense? And what many are finding out is that this is partially a front-loaded expense, but the ongoing infrastructure build-out, like the chips, NVIDIA's chips, have to be replaced every so many years. So the big question right now is how profitable is this actually going to be? Is it going to produce substantial profits, or is the profit margin narrower than most investors think, and therefore warrant a slimmer valuation? And so that is fundamentally the risk that we're seeing in the market.
Well, we just got a GDP report that came out about a week or so ago. It was surprised on the upside. Q3 GDP for 2025 was 4.3%. Benefited by the lowest trade deficit. It was still a deficit, but it was the lowest trade deficit we've had since 2009, probably because of the tariffs. We're importing fewer goods than we have, and that did have a positive impact in GDP. It will be interesting to see what continues. The Q4 forecast that should be reported any day now is anticipated. The Atlanta Fed model is projecting a banner 5% GDP growth. Most Wall Street analysts are much more tempered than that. But the economy is growing. A lot of those uncertainties, what would be the impact of tariffs? Well, I don't know if I would say totally weathered the storm where it's a distant memory, but we have a lot more certainty than we did a year ago. Corporate earnings, my goodness. Where the rubber meets the road is when you buy a company, you're buying its earnings. How's that going?
It's been going fairly well, broadly speaking, but the forecast over the next 1 to 2 years on corporate earnings, which once again we're dealing with forecasts. Forecasts can change because there's uncertainty in the future, but the forecast is looking at 2026 having a 15% growth rate in earnings for the S&P 500. So once again, going back to that valuation question, are we overvalued? Some numbers like that kind of put some of this into question. Now, overvalued from a historical standpoint, absolutely. That's the data cannot be interpreted otherwise. But from a future or earnings perspective, there's still some opportunity, and that's what we're investing in as investors is how can the U.S. workforce generate value?
Exactly.
We're not investing in a political party. We're not investing in our geopolitical ties. While that all impacts the economy, we're investing in workers who create productivity. So,
well, I'm looking forward to this quarter, meeting with clients, sharing our thoughts. With pockets of value still to be had, there's still, if the economy drives profits and profits lift mid and small cap stocks, we're still suggesting diversification, rebalancing, all the tried and true strategies. So thank you for tuning in. Matt, I hope you have a wonderful year, a wonderful quarter.
I'm looking forward to it.
Good luck to those New Year's resolutions, and we will see you all soon.